Are you tired of trying to perfectly time the market? If you're an investor on M1 Finance, you know their platform is built around automation and the concept of set it and forget it. A core part of that hands-off approach is dollar cost averaging, or DCA. What is dollar cost averaging on M1? Simply put, DCA is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the asset's price. M1 Finance is perfect for this because their automated investing feature, the one that uses your custom pies and slices, makes it completely effortless. You set a recurring deposit, and M1 automatically buys the investments in your pie based on your target percentages. This eliminates emotional, impulsive decisions and ensures you're buying more shares when prices are low and fewer when they're high, lowering your average cost per share over time. DCA, ETFs versus individual stocks. The critical choice on M1 is whether to DCA into exchange-traded funds, ETFs, or individual stocks. ETFs, the power of diversification. ETFs are baskets of hundreds or thousands of stocks. For DCA, they are generally the simpler and safer choice. Instant diversification. When you DCA into an ETF like one tracking the S&P 500, every deposit automatically diversifies your money across hundreds of companies. This drastically reduces the risk of any one company performing poorly, tanking your entire portfolio. Lower volatility. ETFs are less volatile than a single stock. DCA works best when prices fluctuate, and by diversifying across many holdings, the swings are less extreme, making it a smoother, less stressful long-term strategy. M1's pie structure. M1 is designed to keep your entire pie, which often contains multiple ETFs, balanced. New money is always prioritized toward underweight assets, automatically ensuring your desired asset allocation is maintained with every DCA contribution. Individual stocks, higher risk, higher potential. DCAing into individual stocks gives you complete control, but it comes with a few key differences. Higher risk and volatility. A single stock can have massive, unpredictable swings. While DCA helps mitigate the risk of buying a single lump sum at the top, a poor-performing company will still drag down your returns heavily, even with consistent buying. You'll need to do much more research. Tracking error. If you have just a few individual stocks in your M1 pie, their performance relative to each other will be more extreme. M1 will consistently buy more of the underperforming stock to rebalance, which is great if that stock recovers, but painful if the stock continues to drop due to bad fundamentals. The verdict on M1. For most long-term investors using M1's automated system, DCAing into a diversified portfolio of low-cost ETFs is the most effective, hands-off strategy. It aligns perfectly with M1's core strengths: automated investing, fractional shares, and dynamic rebalancing. Individual stocks are best for a smaller satellite slice of your M1 pie, maybe 5% or 10%. Allowing you to express your conviction in specific companies without derailing your core long-term strategy. Ultimately, whether it's ETFs or stocks, the most important thing is the consistency that dollar cost averaging provides. With that said, thanks for watching, and until next time.